So many of you asked me about my opinion on IIPR, Innovative Industrial Properties. This is a stock that was trading over $300 per share in 2021 and now sitting at only $70 per share, which is somewhere close to where it was trading at in March 2020. It's offering over a 10% dividend and it's trading at a pretty fair valuation in my opinion. So we're going to talk about why the stock is even going down, what's wrong with it. It's actually a REIT. It's more of a cannabis type of REIT, and most of you actually heard of it. I'm going to talk about why is the stock going down, what are the problems with it, what is the upside with the stock, and if the 10% dividend is actually sustainable, and if I'm personally buying IIPR at such prices or not. Now, if you're not familiar with IIPR, I told you what it is. They have a lot of properties in the United States. Over 91% is actually industrial, 3% is retail, and 6% is industrial and retail. A lot of popular, saying like TrueLeaf, like Green Thumb Industries, Curaleaf, Cresco Labs actually lease these facilities from IIPR, and IIPR collects this, lease payment, and then they just reinvest it into more properties. It's a pretty simple business model. And if we look at how IIPR actually performed since 2017, their net operating income grew over 111% CAGR. Massive growth. Year over year FFO grew 232%. Their dividend actually grew a lot. And if you're looking at all these figures and you're looking at a REIT, not some kind of a crazy, a space investment or whatever, you're looking at a REIT. Well, REIT is a pretty simple and pretty safe business model. So you're looking at all these growth figures and you're asking yourself, why is the stock even going down? Well, one of the reasons the stock is actually going down is from their huge concentration among, around 10 tenants. Their top 10 tenants in total, they make up 72.3% of their invested capital. 72.3% of all the lease payments, they come from only the top 10 tenants. Now, this is actually not bad at all. But a lot of these companies, as an example, I'm going to take Green Thumb Industries, which makes up 7.4% of their invested capital. You could look at the stock. The stock really tells the story. It was trading around $35, $36 per share at the peak in 2021, and now sitting at $7.38 per share. A lot of these companies have the same issues. Cresco Labs is trading at $1.50. I remember when the stock was trading at crazy levels. I mean, Curaleaf is trading at $2. TrueLeaf is trading at $4.45. These stocks were pretty hot before, and now they're not so hot anymore. Now, you might be asking, what does this even mean? Why do I need to care about where the stock was? It all matters, about, the net income and stuff. Well, a lot of these companies are actually not profitable. Some of them are profitable, but a lot of them are actually just not profitable yet. And the way they were pretty much sustaining themselves is they were issuing their overpriced stock at $25, $30, $35. They were using this capital to actually grow their business model into potentially becoming profitable in the future. Now, if you're in the United States, you actually know that this industry is not federally legalized yet, which I'm not sure, I'm not an expert, but I believe these companies can't actually just go to any regular bank and get a loan like something like Coca-Cola can do or some kind of other company, because their industry is not legalized yet. And if it ever becomes legalized, then you bet the Green Thumb is going to be trading, I don't know, $10, $15. Something like IIPR is going to be trading at $150, $200 per share. We're going to have elections in 2024. Maybe they make it a priority. I mean, these stocks can make massive, massive comeback. You're going to see a lot of upside potential if this actually, pretty much ever happens, but this should not be actually your base of investment. So what ended up happening is a lot of these tenants actually started to default on some payments. This was a popular one. In 2022, Kings Gardens, they defaulted on a total of $2.2 million for the months of July, and then we got much more in 2023, defaults of 3 tenants. Parallel, which Parallel is actually a big tenant for them. It's their number 4 tenant, making 7.4%. They started defaulting. Skymint and Vertical also started defaulting on one or more properties leased in Pennsylvania, California, Michigan, but as of now, they're paying on their remaining properties. Now, interestingly enough, what happened whenever Kings Gardens defaulted, IIPR actually issued a lawsuit on them, and they were able to collect collect back around $15 million or $15.5 million in fees, and they were able to take back the two properties that were under development from King's Garden, which was actually not a very bad scenario, and I'm not sure how the others will end. But the main reason why the stock is just a falling knife from $280 per share to $70 per share is the company is very, very concentrated, and this is not getting better anytime soon. Their stocks keep going down. A lot of these companies are private. A lot of them are OTC. So the OTC stocks, there's not as much demand for them to keep issuing shares like they used to actually do it before, and they're not going to get that much capital like they were getting at $20 and $30 and $40 per share. Now their stock is like single digits, which is a big problem. Now the only way this could get solved in the future is if these companies actually fix their capital spending and just magically become profitable, and then it's not as big of a risk for something like IIPR. But the second and the major catalyst is federal legalization. These stocks are going to move huge. IIPR is going to make a massive recovery because then they can actually get capital from the banks very, very easily for them to fund their operations, to become profitable in the future. This would pretty much be a game changer. But if this doesn't happen, this problem is going to keep getting worse unless we have a huge market rally in these OTC, type of stocks, and then they can issue stock at expensive prices again. But if that doesn't happen, there's a very high risk that IIPR is going to see more and more defaults in the future, which is really waiting on the share price. Now, many of you invest in it for the dividend, but it's because the dividend is around 10.3%, which is a very high dividend. It's pretty much their highest dividend ever since the company came public. And we're going to take a look at how sustainable this dividend actually is. And if we compare their cash from operations with their common and preferred stock dividend, which pretty much everything they pay in dividends every year. Now, if we look at the gaps, there was a decent gap in 2020. Their cash from operations was $110 million. Their common dividend paid was $76.8 million. Now in 2021, the gap narrowed a little bit more, $188 million cash from operation. Out of the $188 million, they paid $132 in dividends. Now coming in 2022, when they had the slowdowns, they had some tenants default and a lot of issues, their cash from operation actually grew to $234 million, but the company paid more in dividend of around $185 million. Now the gap is very, very narrow, and it's actually narrowing even more. There's around $50 million difference, which is good, but it's actually narrowing. And I hope IIPR doesn't actually increase the dividend again this year in 2023, because it's going to be a big problem for the company. But for now, the dividend is actually sustainable. And in terms of the expectations for the company, they are expecting the FFO to go from 234 to around 250 in 2023 and 265 in 2024. Now, if that's the case and IIPR is collecting 250 in FFO and they're paying only 185 or 200 million of dividends, this would mean that the 10% dividend is actually safe with the company for now. But the market is clearly not expecting the dividend to be safe. They are expecting more defaults from their tenants, and if they have more defaults and their FFO actually come down, then IIPR would have to cut the dividend. And this is a very likely scenario that could happen if we see more defaults. And in my opinion, we will likely see more defaults, as there's nothing that could save these stocks except either a huge rally or federal legalization, maybe only 2024 election. And if those two things don't happen, then I just don't see how it's going to get better for these type of companies, which is not good for IIPR. But if we look at how much we're actually paying for this thing, we're paying around 8.5 times FFO per share, price to FFO, which is very, very cheap for a REIT like, IIPR. It used to trade at a mean of around 21.5 times FFO, and as high as 45 times, and now trading at 8.5 times. So a lot of the bad news, in my opinion, is actually priced in within the company, and definitely the company is actually undervalued if they can just maintain their FFO. If it doesn't grow, if it doesn't come down, then there's no defaults, then I think the company is very undervalued. But if we look at another metric, which I really like with these companies, and I try to look at it as just the worst case scenario, meaning if the company actually gets liquidated, how much can we actually get? And this is the price to tangible book value per share, and this company is trading pretty much on par, 1 times tangible book, which is not bad at all. But whenever I see companies with extremely bad sentiment, I like them very, very cheap. For example, something like MPW, which is not in the same category, it's not in the same industry, but it's also a REIT, and it also has tenants defaulting, and it has a lot of issues. For example, this one is very, very cheap. It's trading at half times tangible book value per share, meaning if the company just gets liquidated and everything is valued the right way, you're going to get a pretty much, around a 2x on your money for MPW. So MPW is around 7.78. In real terms, if you want to sell it, you get pretty much $14 to $15 per share, which is an amazing return if this ever happened. I'm not saying it's going to happen with MPW. I'm not saying it's going to happen with IIPR. But normally, whenever I look for just very bad sentiment, default type of things, I like them like well below tangible book value, like 0.8 tangible book, 0.7, 0.5, like with MPW. I would feel much more comfortable buying these companies. But for me personally, I am not buying IIPR. I think it's cheap. For me, it's not cheap enough. If the tangible book value per share was like 0.8 or 0.7, that would actually get me very, very interested. But if you're someone that has very high risk tolerance and you would like to maybe, bet on something like some kind of legalization happening in the future, IIPR is actually a very undervalued company. A lot of those things are priced in. I don't know when it's going to bottom, but it could make a pretty big move, maybe $100, $150 per share. The chart is looking a little bit better on this company. For me personally, I think there's better risk rewards in the market. But if you're someone that can take a lot of risk and can actually stomach some volatility, I think IIPR is undervalued with a 10% dividend that could be sustainable outside of any defaults. So if you have high risk tolerance, maybe IIPR is a buy for you. But for me, I'm just finding a little bit better risk reward situations and more margin of safety in the market. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.